All right, I want to welcome Sierra Smith back today. And today our topic is going to be kind of real estate terms and lingo that kind of surprised us when we got started in investing in real estate and kind of getting into the business. So, welcome back, Sierra.
Hey, thanks for having me. I'm excited to dive into this.
Yeah. So for me, when I got into investing in real estate, there was so many terms and kind of acronyms that people would say, and it kind of scares you a little bit at first. Like, am I doing the right thing, or am I prepared for this? And what was your experience?
Same thing. I felt like it was pretty intimidating. I definitely believe that acronyms are like the gatekeeper in every industry because you have to spend so much time just deciphering what everyone's talking about before you can even really learn. And I remember when I started watching like real estate investing content, it took me a couple of months before I could watch a full video and understand everything that they were saying. There's so many different terms and acronyms to learn about and pick up on that I feel like a video dedicated to that could be helpful.
That's true. Yeah, I think, but still, even like every video I still watch, there's always something that comes up in them, and I'm like, what are they talking about? But what have you, I guess maybe, what would be the first few that you came across that kind of you dug deep into and kind of broke it down a little bit more?
Well, when I was completely new to real estate before we bought our first residence, I would say mortgage was the first one that I encountered that I wasn't really sure what it was referring to. And maybe that was just my own, ignorance. But I remember Googling like what is a mortgage because that was kind of the term that was being thrown around. And it's just your home loan. And I was like, well, we call car loans. And why don't we call a house loan a house loan? So mortgage is just the term that applies to your home loan. And so just figuring that out was like, okay, now I know everyone's talking about just your payment on your loan that you got for your house. And that was before I really got into the investing side, but definitely early on when I first started looking at buying a house, that was the first one.
Yeah, and you just found out a little bit something more about mortgage, and we talked a bit off camera, and I found out about it because when I was earlier in my career, I guess people would be always telling me to focus on paying off your mortgage a lot quicker. And how they kind of broke it down or how they tried to explain it was mortgage, or where the word comes from. I think it's Latin, is mortgage stands for death pledge. So this pledge that you're making to pay off your home is kind of how it's looked at. So the quicker you can pay it off, the more beneficial it could be. Now, my mindset has changed a lot about that, but that's kind of where mortgage kind of originates from.
Okay, yeah, I did not know the association with death. I mean, I can hear it now that you pointed it out and we talked about like I was thinking mortuary and that makes sense that that's the same word, but that's wild that that term has stuck even and that we haven't even changed it or gotten rid of it because yeah, that's not necessarily how people leverage their mortgages anymore or they're not pledging to have them till death, I guess. But wow.
Yeah, I mean, I was surprised when someone kind of broke it down that way for me. But that's very big in the like infinite or velocity mortgage type philosophy of paying off your mortgage a lot quicker. But what other maybe terms or lingo have you come across that you think is kind of important?
Okay, so I would say where do I want to go with this? Um, Cash flow was one that I initially, when talking about investments, wasn't sure exactly what that was referring to, and so I kind of dug into how cash flow is um, similar to your return on investment or your cap rate or your yield or your cash on cash return. Uh, there's like a lot of terms that might slightly different in their or differ in their calculation, but are essentially referring to the same thing, like how much is coming back, each month into your pocket, or how much are you profiting off of your investment. So deciphering how and lumping all of those together into like the same bucket of like, okay, every time one of those terms or acronyms is thrown out, like that's what it's referring to. That took a while to sort through.
Yeah, and I think, like you said, there's all these little nuances in each one. So, like you say, cash flow, but there's a lot of people that sometimes say, or they don't include like maintenance or capex expenses, which is, kind of affects cash flow or your cash on cash return. So there's kind
Mhm.
of these, like you're saying, there's these little things that kind of change the numbers, but like you can keep it very simple, just how much cash you're bringing in and how much you're paying out, and that would be your basic cash flow. But there's a lot of other things that can factor into it, like you're putting aside for maintenance repairs down the road, and that could affect your cash flow. But like yeah, like I said, like you said, that there's just so many things to learn in the beginning. And in the beginning, you try to keep it simple, and then you just keep layering on top of that. So what else do you think is something good that people should maybe um, break down a little bit further as far as like a term or lingo?
I would say for on the investor side of it, the 1031 exchange is something that I think every investor should understand probably before they even buy their first investment property. And I listened to that come up in a lot of videos that I was watching was this 1031 exchange process, and didn't understand it for a long time either, and how it worked and what the point of it was. So just a my brief kind of overview of that is, selling one of your assets and moving that profit into another asset of a similar kind, in order to avoid paying taxes on that profit. And so I was like, okay, that is a great way to kind of restructure, move around your portfolio in a way that you're wanting to without having to deal with the capital gains taxes, right then and there.
So we're not legal or CPA advisors here, but I also want to say it's not technically avoiding taxes. It's more kicking their taxes, down the road, or like you're saying, the capital gains. But that's a great point. So I did a 1031 from a condo in Hawaii, and I converted that into about four properties in Pittsburgh. So, like you said, it's a great tool to use. There's a lot of nuances that go into a 1031 that can. I think a lot of times people don't realize the timeline, and sometimes they may put themselves in a bad position by trying to reach these deadlines. So basically, you have 45 days to declare your replacement properties, and you don't have to have them under contract, but in 45 days, you need to declare what properties that you are going to try acquire in replacing the property that you are selling. And then the total transaction has to be completed in 180 days. And so a lot of times, sometimes, when the market was crazy, it was hard for people to find deals in that timeline. And I was fortunate to get it done. However, what I also learned during the process was you have to be very careful in how I guess your final closing documents are recorded. Because, like for example, my transaction, the lender required 3 months of uh, payments taken at closing. So the mortgage payment, insurance, the property taxes, that was all taken out. 3 months was taken out as reserve when I
Mm.
closed, but the tax or IRS doesn't count that as really part of the transaction. So technically, I have to pay taxes on that when I
Mhm.
thought it was going to be part of the whole transaction and I was not going to be getting any gains from it. But when they broke down my closing docs, those reserves that were taken out for future payments wasn't actually included. So when I got my taxes, I was like, "Hey, how come I'm paying taxes on this?" And then they said, "Oh, well, when you look at it, it's not actually part of the closing portion of it." So that was just something I learned doing the 1031, that there's just so much little nuances in it. And
Yeah.
sometimes we get caught up trying to, defer the taxes or worry about the taxes when the actual property or the transaction is more important. But yeah, that's a good one. 1031. I mean, I'm glad I got one under my belt already. But it's a very useful tool. What else would you, kind of advise, newer investors to kind of dig a little deeper into or understand a little bit better?
I would say the last one that I would probably have for investors would be cash out refinance. And that whole process was something that I was unfamiliar with until the recent sale of our primary residence and getting into another one. And had I known about it and what that was when we put our house up for sale, I probably would have just kept that place as a rental property. But I did not think that there was a way to get into another primary residence without just having the savings for the down payment. And of course, with the market that it was, the bigger down payment that you had, the more appealing your offer was. So we wanted all of the cash that we could have in hand in order to get into another primary residence. But had I realized that we could have done a cash out refinance on that property, because our payment on it was so low, we still would have easily been able to rent it out for enough to cover the mortgage payment plus some, and then also have the money in hand to get into another primary residence. That tool would have been, our portfolio would be bigger. So, and then we'd have a great rental property that we had, fixed up ourselves and already knew all of the quirks of and how to handle. So that, especially if you're house hacking or you're doing the live and flip thing, cash out refinance would be a really, really important thing to look into.
Yeah. So could you go a little bit deeper into maybe like how a cash out refinance works as far as I guess maybe if you have a property that's worth 400,000 and then you have a mortgage on it, like how would do a cash out refinance on that?
So talking with a lender and, I think the loan to value or how much cash you could pull out is going to differ based on your lender. So but you're essentially able to pull out a percentage of the equity in your house. And because we had bought our house, I'll just use real numbers, like we bought our house for 135,000 about 5 years prior, and sold it for 220,000. So looking at how much cash we would have been able to just pull out of that, even if we couldn't get the full amount of equity, we would have had enough for a down payment on another primary residence. So, and then, rolling the money that we're pulling out, we roll that into the financing part of our mortgage, right? So our mortgage payment goes up a little bit, but the rent in the area would have still covered that payment. Plus we would have the cash in hand to get another residence, and then we'd have another property in our portfolio. So that's kind of how it works, I should say. And that's my understanding.
Yeah. And another great benefit is that cash that you're pulling out is you don't pay taxes on it because basically
Correct.
it's somewhat of a debt that you're putting back on the property. So you don't have to pay any taxes on that. So that's another great tool like the 1031, the cash out refinance. And then, for me, what I learned a lot of when from starting is like credit score. Like I didn't really realize how much nuances go into getting your credit score. I just thought it was this number that, okay, as long as I'm making payments on my bills, my credit card, then my credit score should be fine. But then you start talking to lenders and you start doing a little more research and you start realizing that it's how many credit lines you have open, it's how long they've been open, what type of credit history you have. I mean, as far as is it credit cards, is it loans? And it's also I guess the open line, the credit, the amount, and then how much you're utilizing of that credit also factors a lot into it. So have you had any experience with like really understanding credit scores?
Yeah, so we had, up until recently been a no credit card family and had never had a open credit card. I think actually we did have one that we opened because our debit card wasn't approved for the amount or something that we were trying to get. I think we were getting tires or something and we couldn't get our debit card to run. And so they made us open up a credit card and then had to pay it off. And then we immediately closed it, which I've since learned opening a line of credit and then immediately closing it is not great
Yeah.
on your credit score. And I don't know how that impacted us because we, didn't look at our credit probably around that time. But we had always just, the only, debt we really had was a car loan, a mortgage, and student loans, and then just our utility bills. Like that's how we were building our credit. And it wasn't until this most recent purchase that we realized we didn't have any revolving credit, which I guess is the credit card side of things. And that even though our credit scores were really good, we were not able to get into the very best bracket for our interest rates because we didn't have any revolving credit on our credit history. So after that, we went ahead and opened up a couple of lines of credit with credit cards so that we could get some of that revolving credit on our credit history. So now our credit scores are looking really good. But yeah, that was one learning life lesson on not that you have to have, I guess, all those parts of credit, but it does inhibit you from getting the very best credit score.
Exactly. Yeah. I mean, I understand why some people don't want to have credit cards or prefer not to use credit cards, but in some ways it's part of the way the game is played, and that's how you can qualify for loans or get better rates. It is your credit history. And like you're saying, a lot of times, yeah, people cut up credit cards because they haven't used it in so many years, or they don't use this certain card anymore. But that definitely impacts your credit score because you're getting rid of these cards that have a longer history, and the longer you keep these lines open, the better your credit score is going to actually be. And these are all things that I've learned as I started going down rabbit holes and digging deeper into these things, and how do you improve your credit score. And it's really opened my eyes to how this world is. You're not taught these things in school. Like, it should be taught, but we don't realize it. And another thing, you talked about having a debit card, and I also want to say that credit cards are very helpful from the standpoint that they provide a lot of safety, like insurance wise. Because, for example, my dad lost like his fourth credit card this year,
Oh,
and or what? Yeah, I mean, he's getting old, I understand, but unfortunately, I mean, he reported it lost, and then we looked at his bill, and there's a $10,000 charge on it now.
oh no.
Yeah, so we're still in the process of getting that resolved. But the good thing is that when you use when even though, yeah, it's unfortunate, but it's our credit cards. So a lot of times there's insured, it's insured. So there's a little bit little risk, less risk there. Whereas if you use a debit card, it's linked directly to your checking account or your bank account, and a lot of times it's not insured. So that's the one kind of drawback of having a debit card. So we'll see how this turns out. But yeah, this is his fourth card he lost, and unfortunately, this one has a charge on it. So trying to get that resolved right now. But yeah, it's great. This is great stuff. I mean, I'm sure there's a lot of new
Yeah, but I mean
investors.
that. Oh, go ahead.
No, you cut off a little bit. Go ahead.
Oh, no.
I can hear you. Can you hear me?
I was just gonna say that
Okay.
even learning about the. Yeah, can you?
Yeah.
Okay. Yeah, I was just gonna say that learning about the perks of the credit cards is something that I hadn't considered prior, as far as they're, almost an insurance policy on everything that you're purchasing, which is awesome.
Yeah. So yeah, this is great. I mean, I think this is going to be super helpful for and just kind of helps people feel more comfortable with that. You don't have to know everything getting started, as far as knowing all these terms, and just watch other people's content, watch people's podcasts, or listen to people's podcasts, watch people's videos, and maybe pick up one thing in each video and kind of break it down and get a better understanding of what that is. And but there's just so many things out there, and just kind of find what you're comfortable trying to understand and break down. But just get started. That's the main thing. Get started. You're not going to know all the answers, and thanks for coming on again. And I don't know if you're still there. We're having some technical difficulties, but thanks for joining me again. And I don't know, are you there? Can you hear me?
Yeah, I can hear you.
Okay. Okay. I wasn't sure. You're kind of frozen. But do you have anything else to add?
No, I'm with you. Just get started and don't be afraid to ask, professionals, ask real estate agents and lenders those questions. And you don't even have to try to sleuth it out online. If you just go straight to the source, you can probably get a really concise answer really quickly.
Awesome, great advice. And I hope everyone goes out there and goes and checks where the word or the term mortgage comes from and verifies what I said. And now you have a better understanding of where that term comes from and why some people look at it as this death pledge of making a payment on your home. But thanks for joining me. We'll do this again and we'll come up with another topic for next week. Thanks, Sierra.